Hi, everybody. Welcome back to another edition of VCTV. I'm your host, Kyle Ellicott, and today we're going to be speaking about what you need to do to prepare a business for exit. Whether that's in the public markets, the private markets, it's an M&A or merger and acquisition, it's to private equity, maybe even SPACs, or as we were just speaking about earlier today on VCTV, tokenization. There's so many different ways to have your business go through an exit process, but what do you need to know to prepare for that? Also, as investors, what do you need to prepare on both sides? If you're looking to acquire, maybe as a family office, or what do you need to do and know to help your portfolio companies prepare for their exit opportunity as well? Well, I'm joined by some outstanding friends and co-hosts from around the world of the VCTV family to talk just about that. But before we get into it, big thank you to the LaToken team, to Maria and Hasmik for making today's episode possible. If you haven't already done so, please check us out on latoken.com to hear from today's speakers and all speakers of the VCTV family. And make sure you click that subscribe button to tune in to all episodes of VCTV that we cover all day, every day, globally here as well. Vandana, welcome to the show. A little intro, a little background for everybody, and we'll come around for everyone else and we'll jump right in.
Yeah, so firstly, thank you so much for having me here. It takes a lot of efforts of LaToken TV, especially Maria, Hasmik, Carol, Kyle, to get this show and connect people from all over the world globally. And I think we are privileged to be here as speakers. So my heartfelt thank you to all of you. Today's topic is very interesting. Preparing for exit, and there are a lot of insights that I would like to share a bit later. Coming to introduce myself, I had my own family office in Singapore and Jakarta. I worked as an investment banker and advisor to family offices and angel investors in Jakarta, Indonesia, helping startups from a diverse background, from fintech, B2B tech, all the way to consumer startups. I was raising funds for them and providing them with a range of services, just as Convanto does today. After 15 years of staying in Singapore and Jakarta, I came back to India. I did investments for a bit and then returned to advisory. That is when Convanto was founded. Today, Convanto is one of the most well-known boutique investment banks in India and led by a female founder. Today, I'm also a venture advisor with Loyal VC, the INSEAD-led Canadian VC fund, having a core portfolio of over 160 investments in more than 35 countries. I'm also a partner with GST Venture Studios, a Silicon Valley-based venture builder. Over the years, I've arranged funding for startups and growth stage companies in diverse sectors like edutech, fintech, consumer, B2C and B2B, agri-tech, health tech, food tech, disruptive and deep tech, as well as non-tech sectors. I would recommend all of you to please do have a look at my website for the wonderful testimonials written by my clients. This month, I've been nominated as one of the top 10 women leaders in Wealth Management 2021, and my expert opinion is often sought by leading business news channels and publications like VCTV and Business World, and I have participated in 155 talks all over the world. You can easily see all these talks on YouTube and VCTV streaming sites. I'm connected with 300 plus investors globally, and I pick up global deals while being sector agnostic. Our ticket size is $1 million to $25 million. And once again, thank you for having me here and looking forward for today's interaction.
Thank you, Vandana. Same as well. Appreciate you being here. Randall, coming to you next. Peter, you're going to be last today. Quick introduction, Randall, on your side for those who may not know you.
Yep. Hi, everyone. My name's Randall LeBeau. I am a co-founder of Boss Capital Partners, an investment syndicate. We focus on seed to Series A and look for companies that have product market fit but lack operational expertise. I am also a co-founder of Boss Startup Science, which is an educational platform to help entrepreneurs prepare for exit, build their business, essentially build a foundation, grow, scale, and exit very quickly. My experience and my specialty is in growth. So I define that as sales, marketing, service delivery, support. I have experience as both an entrepreneur and investor. I was part of a $900 million divestiture from eBay, and then later helped turn around a company within 3 years as part of that deal for a $1.8 billion exit to Adobe. I have been part of 8 transactions between 20 million and 100 million. And really looking forward to sharing some of the things that I picked up along the way.
Absolutely excited to hear a little bit about that experience here in just a moment. But before we get into that, Peter, a little intro, a little background.
Thanks, Kyle. First of all, thanks to Maria and Hasman and everybody at LA Token. I don't know how you do it day in, day out. These LA Token talks, they're just so productive, so useful, and to be on top of it. So, a million thanks. The other thing, I mean, coming after Vandana and Boss Capital, I mean, how do I even live up to that? So Peter Plout, the executive director of Weimer Family Office. We're a multi-billion-dollar multifamily office based in London and Denmark. I'm originally from the States, as you can tell from my New York accent. I'm very much looking forward to today's show. I've spent the last 35 years providing capital, both equity, debt, and structured finance to companies all around the world, from very, very large to the very, very small. I'm an investor. I'm an investment banker. I'm a research geek. So hopefully I could add a lot of value to this discussion in terms of how we look at companies that are prepared for an exit or preparing for an exit, what they need to do.
Wonderful. Well, thank you all very much for joining. And Randall, I actually want to start with you. I mean, you've gone through this process, it sounds like, on all sides of the table, but maybe more on the entrepreneurial side. More recent, I mean, with a $1.8 billion exit and then some with the 20 to 100 million range you gave earlier. What was that process like, just from a mental standpoint? What was that process like as an entrepreneur going through that type of transaction for almost $2 billion? If you could walk us through that.
I mean, that was nerve-wracking, and as you can imagine, takes quite a while. That was Magento. An e-commerce platform, and I was CMO at the time during that transaction. And so one of the big things was to start to monetize this open source service that had been created. And one of the ways that we had to do that was to begin with the end in mind. There were a lot of different avenues to choose in terms of how to monetize this open source platform and all the developers that were working on building code on top of this. So what we did is looked at 2 different options. We had B2B as an option based on a ecosystem market landscape. We realized that was an opportunity that could potentially help us. But as we looked at the potential buyers of a B2B service, we realized that the multiples weren't quite as high as what we would have typically expected, and we wouldn't really get the return on the investment or in the investor expectations. So we looked at the ecosystem that had been built around this open source platform and realized that it was a $5 billion ecosystem. Now, at the time, Magento was about a $100 million company. So in order to capitalize on that, we built a very strategic marketplace, and this marketplace was connected to valuation drivers. And the valuation drivers were important because they weren't just a marker on how we were driving the company, but they were a marker on our potential acquirers and what they valued in terms of what we called valuation drivers, something that would increase the multiple or increase the valuation. By operationalizing and monetizing this marketplace, we were able to cut that investment thesis or exit timeline that we had originally planned for 5 years down to 3 years. And it was very profitable, going from about a $100 million company to $1.8 billion exit.
Wow. And if you had to do it all over again, lessons learned, and what would you do differently?
So through that process, kind of learned a formula, so to speak, of how to develop an exit strategy and how to really guide or use your go-to-market as a vehicle to exploit and capitalize on your exit strategy. And so the things that we looked at were first, who who is potentially going to buy this company, and let's do some pattern recognition research. Over the last 3 to 5 years, how many acquisitions have these potential acquirers made? What was the strategic play behind them? What was the revenue of the company at time of acquisition? So on and so forth, right? We're trying to get a realistic expectation. Then we want to understand why they would buy the company. Are they going to be buying it on income or savings? So revenue or profit. Then we wanted to know, what are they going to be buying? Are they looking to buy the company holistically and continue to run the company? Or are they looking to just buy the product and the revenue or the engineers, right? This was all very important. Then are they looking at top line or bottom line? And this is a pattern that you see in terms of if you're going for bottom line or EBITDA versus top line, it's going to be a different type of transaction. You're going to have different valuation drivers. You're going to have different milestones that you have to achieve to get there. Typically, the multiples are going to be higher in a bottom line scenario. And then we looked at the growth drivers, right? What were they valuing the company based on? Was it growth of user or growth of revenue? Was it retention? Was it margin? And then one of the biggest ones, which I think people overlook a lot, is attachment rate. So that's saying I have and service the same customers as my potential acquirer. If an acquirer is in an expansion play, meaning they want to expand in a current market, they're looking to expand the share of wallet that they have. And if you could provide a new service for them to sell to an existing customer, that gets them more share of wallet and typically speeds up a transaction.
It's a great point, and I would agree that gets glossed over. It's something we don't hear a lot about when we do talk about the M&A process as well. And Vandana and Peter, I see you both shaking your heads. Vandana, I want to come to you first. Any thoughts to add on to Randall's experience and maybe the experience you've had on both sides of that table as well, either preparing for an exit or working with a company towards their exit as well?
Yeah, in fact, he has shared a very good example, and a very good option of exiting a business is to merge or get acquired by another company. Mergers of companies with complementary capabilities bring economies of scale to the newly formed business. And, look for a capitalized acquirer who can close deals fast on a professional terms. In an acquisition, the entrepreneur's equity will be taken over by the acquirer, thereby providing him with an exit. And you should be wary of running your company with the aim of being acquired by one specific company. If your planned acquirer is not interested, you are risk building a product so specialized that no other business will even buy you either. Now, the first step should be to prepare your finances. The first step to develop an exit plan is to prepare an accurate account of your finances, both personally and professionally. And the businesses should consider their options. Once you have a complete picture of your finance, consider several different exit strategies to determine your best option. Then I feel you should speak with your investors, approach your investors and stakeholders to share your intent to exit the business. Create a strategy that advises the investors on how they will get repaid. And also, once you've decided to exit your business, start transferring some of your responsibilities to new leadership while you finalize your plan. So choose your leadership well and tell your employees when your succession plans are in place. Share the news with the employees and be prepared to answer their questions. Inform your customers, and finally tell your clients and customers. And if your business will continue with a new owner, introduce them to your clients. So if you're closing your business for good, give your customers, alternative options. This is what I wanted to add to everything.
Thank you very much. Peter, to you, anything to add? But also, I want to flip the script for a minute. As a family office, you're investing, but you're also looking at acquisitions, right? You're looking to acquire businesses into the family or the family's business portfolio. So how have you looked at working with businesses towards that exit in your portfolio, or how have you looked at acquiring those businesses that might be ripe for exit?
Okay, Kyle. So a lot of questions there. First of all, I want to follow up on what Randall mentioned. Look, Randall's in the mud there. He's got the operational characteristics because it's his company that's looking for the exit. And I think what's important to note from an advisory point of view, then I'll talk about from an investor family office point of view, because I've been advising companies for 35 years. I think the most important basic concern is, and Vandela brought this up too, about the employee impact, but what's the purpose of the exit? What is the proposition? Is it an operational one? Is it because the next generation, it's a private company or a bunch of fuck ups, so you don't want to give the company to your kids or grandchildren? What's management's incentive? Is there a better management team that's coming along that they could help grow the company? In that case, it's probably selling to a private equity company that might have a deeper bench of management experience. What's the impact on the investor? What's the impact on the employee? So the first important point is a holistic point. What is the proposition of the exit? What's the reason for it? Then we go into what Randall mentioned in terms of the valuation. How is that valuation determined? You might have internal metrics that might be very different from a peer group analysis that an investment bank might put forward and could be shocking to some. So what's the valuation? How that valuation is determined is very important. Then we have to go into the next stage is who is the acquirer or what is the exit? Is it a strategic sale to a strategic investor where you might get a higher valuation because that strategic investor needs your company as part of their growth formula? Or is it a sale to a private equity or activist investor who thinks that they've got the bench to extract more operational efficiencies out of the company? Very different type of animal, but needs to be discussed. If we're talking about a private, or is it a public exit? Again, is it an exit to another private company? Randall mentioned B2B, or is it a public exit? And if it's a public exit, what format does that take? Is it an IPO? Is it a PIPE? Is it a SPAC? There's been a lot of talk about SPACs. We've seen that, but SPACs have been around. That we've had a different forum on that just the other day that I attended to. So what is the format? All those things need to be considered as part of the exit strategy. In terms of what we're looking at from a family office point of view and a multifamily office, we're dealing with multifamilies with sometimes competing interests. They might be entrepreneurs representing various different asset classes, but also we need to look at it from the protection of multi-generational wealth. So what we're looking for is we are not an activist investor. We don't have the operational expertise that Randall and his team does for the businesses that we either look to invest in or acquire. We're looking for management. We're looking for people with a great track record in the asset class that they are operating in, that have been through various cycles and have managed through those cycles. We're passive investors, so we're looking for somebody to protect our multi-generational capital, whether that's equity or debt, although we're always looking for equity-like returns, even if we provide debt financing. And then obviously, most important to us is an exit. We're not there for multi-generations. We're putting our capital out for about 5 years, Kyle. We want to see our capital returned with an adequate return for the risk that we're taking. And that's across all asset classes.
And I'm seeing shaking heads. I mean, that's a great point as well. I mean, investors are not just looking to make the acquisition, but also see a return of capital as well, which is sometimes also not considered in that equation. Vandana, to you, I mean, as you look at your investment process and the coming years ahead, and we may have lost over there for just a moment. So, Peter, I want to come back to you on that just a moment. So you talked about private versus public. Is there a checklist that you go through when working with companies, either in the family's portfolio, or excuse me, the families, plural there, that you go through when they're looking to go through an exit on the public side and or the private side? Do you guys have a checklist of things that you go through and targets, milestones, et cetera, that you look to achieve?
Well, most importantly, look, I'll turn over that. It's a good transition into Randall, but from our point of view is we look at it from a management point of view. Is the company better off in private hands, which is less regulatory scrutiny, less financial reporting, and therefore can basically go and be very independent? Or do they want to have the increased regulatory attention, the filing requirements, the SEC and others, whether if it's in the United States, for instance, or the other regulators in other countries. What is the benefit of being a public company? It might be easier access to a broader range and a deeper bench of capital. I'm talking about retail capital, because private companies can get plenty of capital from the institutional point of view or the VC capital point of view, so be it. So I think it's very important to understand is, why are you seeking an exit in the public markets? How does that benefit the company? And do you want the enhanced scrutiny? If you don't, you're better off remaining in the private hands. The other thing is the question is, again, can management in its current format run the company better than if it was to sale? And whether that sale is through an IPO or that sale is B2B, as Randall mentioned prior, to a company that has a deeper bench of experience and talent. So those are some of the things that, we leave it to management to decide whether their company is better off in which hands, but then obviously give them guidance if we have a very strong view of whether it should be sold, because it's reached its plateauing, and in order for it to extract other value. And what I mean by value: increased valuation, increased returns for the shareholders, which are us, the owners of the company. Does that need to be through some type of exit to a strategic, activist, or other private company?
That's a great point, Randall. I mean, to you, private versus public, lessons learned, and maybe that direction path that you think of now when building a company, and directions that you may, path you may guide a company in, whether it's private versus public, to Peter's point.
Well, it's all relative, and it's based on the industry. Like Peter said, the group of people, we look at it almost as like a horse and a jockey, right? You have the individuals running the company, their strengths, their capabilities, and then you have the reality of the actual product or service itself. What could this do in the market based on historical results? So regardless of whether we're going public or private, we look at it as embracing the principle of beginning with the end in mind, and that very similar to someone driving somewhere where you would need a GPS. You have two coordinates. You have where you are today and where you want to go in the future. And once you put those two coordinates in, the GPS routes the path for you. No matter what path you're given, you still have the reality of certain milestones and like growth milestones that you have to achieve. The first is to vision, then to product, then to revenue, then to profitability, and then to exit. And the reason that those milestones are important, because if you looked at those on a timeline, time matters as well as opportunity in this equation. So if you look at the typical life cycle of a company, trying to achieve some sort of outcome, exit, IPO, whatever it is, it's typically in a 3 to 5 year life cycle, unless you're a unicorn. In that 3 to 5 years, there's very key milestones that are important, such as your go-to-market, right? And when you're trying to achieve revenue. The reason that that's important is because when you go to market, you have a big red flare going up saying, hey, I have this new capability, new product, new service, whatever it may be. Typically takes about 2 to 3 years for competitors to copy your product or service, and in fact, potentially build it better. At the same time, you have to be looking at your potential acquirers and making sure that you plan out your maturity milestones along with the rounds of fundraising that you're going for in order to leave upside for that potential acquirer. So get to market and get to exit before your competitors can catch up to you, and get to exit while you could still leave upside for your potential acquirer, making sure that you have a smooth transaction.
That's a very, very good point. And just for the sensitivity of time, I want to come around. Thank you, Randall and Peter. I want to come around for closing thoughts on preparing a business for exit. And Vandana, I want to start with you. And of course, where can you be found online as well? So any closing thoughts you have around this process? It is a very big process to add to the audience, something we're going to continue to cover here on VCTV. We talk about public markets in general. We've talked about opportunities around the SPACs market that we saw explode at the end of 2020 and grow even further in 2021. We also have talked about, again, equity tokenization and that new path. as well. And we've talked about mergers and acquisitions many times as well here on VCTV. So don't be afraid. Get your questions ready. We're going to continue this topic much more here in 2021. But Vandana, closing thoughts. And again, where can you be found online for those that want to continue the conversation?
Yeah, so first of all, my humble apologies. The screen froze and there's some internet issue, it seems. I had to just say that, when you are ready for an exit, there are a few things that, I would like to highlight. The first option is to give exit to the investor through an IPO in approximate 5 years. If the IPO is not possible, then the company should appoint an independent valuer of shares and find a third-party investor who will buy the shares from the original investor. And if the second option is not possible, then the company should buy back the shares from the original investor by giving them the required IRR. And if the third option is not possible, then the founder should buy back the equity from the original founder by giving him the required RR. And if all of the above doesn't happen, then the company should look for a strategic partner and one who buys a big stake in the business as a strategic investor and not as a financial investor, and hence gives exit to the original investor. And I could be found on LinkedIn or my website, www.convanto.com. And once again, thank you for having me here.
Thank you very much as well, Vandana. Peter, to you, closing thoughts, and where can you be found online for those looking to continue the conversation?
Thanks so much, Kyle. It's very simple. A operator of a company, an owner of a company needs to understand what is the exit proposition? Why do they want to exit, and how do they want to exit? What is the value proposition to its key stakeholders? Those are not just the investors, but the employees and founders as well as the entire management team. If that question is, we're prepared and the time is right for an exit, then we need to decide, is it strategic? Is it PE activist? Is it in the format of a private market transaction or public market transaction? I'd be happy to help people with any advice on that. You feel free to reach out to me at the Weimer Family Office at peter.ploud@weimerfinancial.com or by my mobile number, which I put on the screen. And really appreciate, as always, being honored to be a participant here.
Thank you very much, Peter, as well. Randall, closing thoughts. Where can you be found online as well?
Yeah, I could be found at bosscapitalpartners.com and bossstartupscience.com. And Kyle, thank you very much. This is a great topic and an important topic that should be discussed more often. So thank you for having me. Appreciate it.
Thank you as well, Randall. Thank you, Vandana. Thank you to Peter. Furthermore, really appreciate the thoughts and insights shared today. To our audience, thank you so much for tuning in. If you haven't done so already, please like and subscribe. Like today's episode, share today's episode, and subscribe to the VCTV channel to hear from today's speakers and all speakers of the VCTV family. I'm your host, Kyle Ellicott. Please do reach out to all of us here on today's panel. Let us know where you heard us, where you met us, and what you would like to continue the conversation about, whether it's relevant to today's topic or other topics as well. And a big thank you to the Token team, to Maria and Hasmik for making today's episode possible. With that, everyone have a wonderful day, and we'll see you back here tomorrow with more VCTV. Take care, everyone. Bye.